Greetings everybody, and in this video we're going to talk about exclusions from gross income. Let's hit it. Greetings everybody and welcome back to class, and in this video we're going to talk about basic income exclusion provisions to compute gross income. Now, I don't want you to be worried too much about this. There's going to be there's a potential for one or two questions about this, but it's a topic I think there used to be a lot of these exclusions from gross income. There's still some, but there used to be a lot more. As you know, there's just certain things that, as America, we said these are certain things that we want people to do, and as a result of which, if you do these things, we're not going to tax you on the income that gets generated from it, or there's going to be a deferral of the income if you meet certain conditions, and blah, blah, so on and so forth. A lot of them have been going away, mostly because it's perceived as tax dodging and not very acceptable to moral society, that some people pay taxes on income and others don't get to. But again, like I said, I think you're starting to see a lot of this start to disappear. But there's, and look, I think that first point pretty much says it. Congress decides these, and they decide them. I don't want to get into politics, but I think there's a lot of people. I think there's a lot of people who say Congress does it just to take care of their buddies, as opposed to, for any common good. I think that gets done too quickly. That accusation gets thrown around a little too carelessly. So, for example, why does Congress, not tax municipal interest? Well, there's actually a couple of good reasons why they don't. Number one, there is this separation between federal and state powers. That's one main reason why we don't do this, because and something you guys may not know, because we don't really talk about it much in this class. Treasury bills, T-bills, notes and bonds, we don't tax those at the state level, and the states actually legally cannot tax U.S. government debt. Federal government can tax it, states can't. Okay, so it goes both ways. And it's interesting. It's very fascinating because as I've been studying more and more for my security stuff, that has you're seeing the bigger picture and kind of reasons why people are doing this stuff. But also Congress wants the states to have the ability to raise funds on their own and have that as a tax deferral privilege, because of the reasons it helps states grow. Okay, so there is some good being done with that. Now, there are some areas where states are probably doing some things that are not necessarily just to grow the state, but also might have some ulterior motives, shall we say. Very good example. I'm here in the state of Virginia. They decide that they want to build, the Washington Commanders. They've been talking about moving them from FedEx Field to somewhere else. Because FedEx Field's a little old and getting a little dilapidated, and so they want to build a new. Again, if your stadium's not built in the last 10 years, it's old. I'm still trying to figure that one out. And Virginia has been talking about trying to court them over to here. So maybe Loudoun County says, okay, we're going to build you a stadium here, and we're going to put in $100 million. Get the land, build the building, blah, 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 so on and so forth. And then we're going to rent it to you for $100 a year. That's a pretty good deal, isn't it? Now, what do they get out of it? Well, all the concession stands are state-owned, we'll say. I don't know if that normally happens, but we'll say that it's state-owned. Maybe the garage there where the cars park is state-owned, so the state's going to make some money off of this. It could also be a fact that, maybe Loudoun County passes a special tax that says any business working in that stadium has to pay a special tax. There's 100 ways this could go. And again, it's all subject to negotiations and all that sort of stuff. But that, as opposed to a general obligation bond, which is used to build roads, bridges, schools, and all that other stuff. Again, state governments and county governments have a responsibility to build schools, bridges, roads. That's their role in our society. It is not the role of society for the county to build stadiums so they can attract football teams. So when you have a general obligation bond that's going to actually pay for a lot of that stuff, that's your municipal interest that is 100% tax exempt at the federal level. Okay? But if we do it as building a stadium somewhere, now that's going to be what's called a private activity bond that, for federal taxes generally tax exempt because it's sponsored by a local municipality. But for alternative minimum tax, which we don't talk about too much in this class, we're not going to let that slide. And you're going to have to calculate an alternative minimum tax. Now, for most people, this won't be a big problem because alternative minimum tax usually doesn't kick in until I think the lowest I've seen it in this office, we had one client who made about $500,000 a year, and he was getting hit with alternative minimum tax because of some preference items that he had on his return. For the most part, most people don't get AMT anymore. So maybe not that much of a deal. But again, you got to understand, subsidize, they want to subsidize or encourage particular activities or to mitigate inequity. But the municipal bond interest, usually they're doing that because they're trying to give the state and local government some opportunity to grow itself and all that. Gains on sale of personal residences. There's actually a really cool story about this. Although I hear some people don't like my stories. So maybe I shouldn't tell it. I don't know. Let me think. You know what? I'm going to tell it anyways. Damn the torpedoes, full speed ahead. Gains on personal residence. How'd this happen? So what happened is actually a buddy of mine who is actually he's one of the lead lobbyists for the National Realtor Association. Basically, he said, look, I think it was Congress. It was either Congress or the IRS. I think it was maybe the IRS went to Congress, and Congress said, okay, we'll do this. And they went to the National Realtor Group, and they sat down with them. This is before my friend worked there. But he heard the story from his predecessor, what had happened. And he said, look, and Congress said, look, we want to do a special exclusion on sale of property, personal use homes. Would you be up for it? And they just dropped their jaw. They're like, we didn't have to lobby for this? This is the greatest thing that's ever happened to us. But why would Congress come to them and say, look, we want to give this sweet, juicy tax deal? Well, first of all, encouraging people to buy their own home is a goal that Congress has oftentimes talked about. It's generally seen that when people have their own home, self-efficacy goes up. Pride in their community usually goes up. Okay? People tend to be more stable when they own their own home. Okay? If you live in the house for the entire time of your life and you pay it off, you can get to the point where you don't have to pay rent or mortgage payments anymore, which makes it less likely that you're going to need government support. There's tons of reasons why they do these things. And it's not just to give, greedy rich people a tax break. But they do these because, society can benefit from this. And I would say one of the reasons why the IRS would have pushed for this, if they did, I'm assuming they did, I don't know that they did, auditing capital gains on personal homes was probably costing them a lot of money. And that's, like one reason why we increased the standard deduction the way we did back in 2017 was because the IRS got sick and tired of doing all these audits on itemized deductions. It's too much money, so it wasn't worth it. Let's just increase the standard deduction. We don't have to audit this stuff anymore. Okay, sounds good. Okay, so there's times that they're going to do it because it benefits the government. Is they're also going to do it because it benefits society. Or maybe they're trying to get something. Right now, one of the things that we have, and I'm actually shocked we haven't done more about this, maybe because in the United States we don't find it to be bad. almost every developing country, almost every developed country, I should say, first world country, is experiencing a generational problem. Not having enough kids. Okay? United States, this isn't much of a problem for us because we're in the same boat. Our replacement birth rate is very low, but because we have so much immigration coming in, we don't feel it. But there's other countries, China, Japan, Korea, Europe. There's a lot of European countries that are having this problem, that they're falling below replacement rate on the population, which is usually 2.2 for every couple. We're going to have to encourage people to have kids. And since, we don't have farms as much anymore, where kids were, many people back in the day when they were farmers, they had kids because they needed free labor. Don't need that anymore. Now kids are a luxury. So I would expect that in the near future, you're going to start seeing a lot more Congress coming out and saying, okay, you want to have a kid, here's a nice juicy tax credit. And I'm going to say it's going to be the tax credit that's going to make the $2,000 tax credit look like pennies on the dollar. They're going to have to do it because they're going to need to make sure that they're getting enough kids. Okay? So, anyways. The gain on the personal sale, we really talk about this more in chapter 14, but we're not going to take chapter 14 in this course. All you have to know about this is that it's $250,000, $500,000 if married. It hasn't changed since it was implemented back in 1997. You do have to satisfy ownership and use tests. It's 2 out of the last 5 years. And any excess gain does qualify as long-term capital gain. Why long-term? Well, if you qualify for this, you have to be there for 2 of the last 5 years. That's more than a year, folks. Automatically long-term capital gain. Don't have to think about this. Fringe benefits. Common fringe benefits are going to be medical and dental insurance. That's the largest fringe benefit that is actually in the tax code. That and retirement contributions are the 2 largest tax benefits that are granted by Congress on the individual tax case. If your employer gives you health insurance, you don't pay any taxes on it. If they provide to you a 401k contribution, that's huge. Okay? Especially if you're doing a traditional style 401k. Life insurance coverage, de minimis, small benefits. For example, my employees come in and I give them, they get to the end of the year and I say, hey, this is great. You survived. Here's a nice fancy pen that I spent for, $15 for that has their name engraved on it and it looks really neat and feels really good. But de minimis because it's under $25. Okay. And this is where they're going to kind of get into a lot of that. Yeah, and really the de minimis is because of administrative convenience. So, for example, very good example of this would be if I brought cookies to work and I spent $50 on cookies. By the way, if I'm spending $50 on cookies, they're better be damn good cookies. And I give them to all my employees and to the office workers in the other offices and things of that nature. Am I going to sit down and try to figure out what, Dan's portion of those cookies are? It's an administrative nightmare. And they're going to be like, look, it's small. Now, I can't go to Congress and say, well, I handed a card to all my employees. That's pretty hard to figure. They're going to be like, Kevin, what are you smoking? Don't do it anymore. It's not good for your health, your mental health especially. Okay? It's de minimis. It's got to be small. And small is relative. And it's subjective. Okay? Generally, I would say anything under $25, you're going to be able to wipe out pretty easily. Okay. Life insurance coverage. If there's a group policy up to $50,000, you don't pay any taxes on it. Anything above that, you will. Medical and dental health insurance. An employee may exclude from income the cost of medical insurance. Again, that's Code Section 106. Very important. Education-related exclusions. Now, here's the deal. We want people to go to higher ed. Because if you pay for your children to go to higher ed, they're going to be better educated. They're going to be more prepared to go into the world. And when I say better educated, I don't necessarily mean four-year institution. I'm actually starting to come to the point in my life where I'm beginning to realize college isn't for everybody. I know a lot of people who go to trade school. They're incredibly successful, very good at what they do. And maybe after that, they can go to, I knew a very good friend of mine who went to welding school. Actually, we lost touch with each other and then came back, about 2 years ago. We started talking to each other again. It wasn't that we hate each other, it's just we went different ways. And when he was in the military, he actually was a welder. I had no desire to go to college. He was making good money doing welding, making really good money as a welder. And then what ended up happening is roughly about 5 or 10 years, I think it was between 5 and 10 years ago, he ended up going back to school to get his business degree because he said, look, I'm setting up my own welding company. Okay. College was not for him at that time. And I love him to death, don't get me wrong, but he's not an academic. Okay. He's not an academic type. He was, played football, good guy in that sense. But college was not for him. And so again, he went through the military, but if his parents said, look, we know you're not college material, we're going to send you to Lincoln Technical Institute, let you learn how to do welding. Your education related exclusions, you can do, again, if you have the scholarship to go to that kind of a school, you don't have to pay taxes on that. Because the government knows they're going to get more tax money out of you after you graduate and go and earn big bucks. But it also happens the same way for college people. You get a scholarship coming here, you don't pay taxes on that scholarship. Now, if you're required to work to get that scholarship, then that's income. That's compensation. Okay. Other education subsidies, you can exclude from gross income earnings in 529s or Coverdales, as long as they're used to pay for educational costs. Taxpayers can elect to exclude interest earned on Series EE bonds when redeemed to pay for education, qualified higher education expenses. And the exclusion of the interest on Series EE bonds is also restricted to taxpayers with modified income. That's pretty low, actually. I've only had like 2 clients who tried to claim this, and they got denied in both because they just made too much money. It's kind of sad, actually. Exclusion that might mitigate double taxation. So, for example, if I pay inheritance tax on something, I can get a tax deduction on my tax return for the portion of the inheritance tax that was paid by the estate that flows down to me. We don't talk about this much, but estates and trusts can operate as flow-through entities where you get a K1 and it comes to you. On the estate time, usually it's not as much about income as it is expenses that get thrown to you because of this exclusion that ends up happening here. I wouldn't see too much of this on the test. It's probably not going to be touched too much. We may talk, I don't even know if we're going to talk about gifts, unless we're talking about basis calculation. That'll be in the second part of the course. Life insurance proceeds. Again, death is not a method to avoid taxes. Well, you can try it, but it only works once. So again, if you die, there's several tax benefits that end up happening. While death and taxes are the only 2 constants in the universe, death does stop taxes. Okay, at least for most people. Some people it doesn't. Some people are going to still try and tax you after you're dead. All right. The life insurance proceeds are typically subject to federal estate tax, but not income tax. You don't have to worry about the estate tax. Don't even think about estate tax. Life insurance proceeds do not exist on income tax. That's all you need to know. Okay? Exclusion does not apply when the life insurance policy is transferred to another policy for value. So that valuable consideration, what they're talking about there is sometimes you can... So say, for example, I have a life insurance policy, we'll say for $1 million. And I find out I've got cancer. And they come back to me and they say, Kevin, your chances of beating this are pretty low. Okay. And I say, is it going to be painful? They say, yeah, it could be, but if we put you through this treatment, we can mitigate that pain and at least give you quality of life as you're going to do this. And I'm like looking at my assets, and the only thing I got is this blooming life insurance policy. So I sell the life insurance policy to a company that gives me, $600,000 on it. And basically they're just waiting for me to die. And once I die, they give me $600,000. They're not going to ask for $600,000 back. They're going to ask for like $700,000. Or, they're going to say $600,000 plus an interest amount up to the $1 million policy, depending on how long I live. Okay. So accelerated death benefits in certain circumstances could qualify for this. But again, that could be an exclusion that could exist. And again, you got to really do your homework. That won't be on the test, but it's definitely something you want to know it could happen. Foreign earned income, it's up to $120,000 this year, plus another $16,800 for housing exemptions. By the way, my firm, we do tons of these, but I don't tax it very much in this class because it's a very specialized area of tax. You just got to know it exists. And the fact that they can exclude, that's all you need to know. And you should know all of these exceptions. Number one is what we call bona fide residence test, BFR. Basically, you live in another country, you're taxed in that other country, and you're like, look, I pay taxes over in Spain. I should not have to pay taxes in the United States on the same income. And again, if you're making less than $120,000 a year, it's easy peasy. You can do that, and then you pay your taxes in Spain, and you owe no taxes here in the United States. In the United States, we tax worldwide income, but if you're making $400,000 a year, we're going to wipe out $120,000. But then every other dollar after that, you're going to have to rely on the foreign tax credit to get you out of the taxes in the United States. And if you're living in a country like Spain and you're making $400,000, your taxes in Spain are going to more than wipe out your U.S. income. Now, again, the second one, first one was called BFR. Second one is called PPT, physical presence test. Again, you qualify for it. The first one is more of a facts and circumstances test. You got to be able to prove to the IRS that, yes, I am a resident of the other country. Here's my document here. Here's my driver's license. Here's my other stuff that I do, blah, 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 so on and so forth. And the second one, the PBT, is what we call the mechanical test. I was here for 330 days. I was outside. Actually, I wasn't even here. I was outside the United States for 330 days. Here's my passport that proves it. And the IRS goes, okay, got it, uncle, we give up. Okay, it's nice when they say uncle. I'm not going to go the example. You're not going to see that on the test, more likely than not. Sickness and injury related exclusions. Again, if you are sick or injured and reflect their inability to pay or facilitate, to pay the tax and facilitate recovery, you can apply for one of these if you are sick and ill. Okay. Workers' compensation, payments from workers' compensation plans are excluded from gross income. So if you slip and fall at work and you end up going home and they end up paying you some extra money in order to recuperate, all that's tax exempt. Okay. Payments associated with personal injury. Again, so say for example, I'm walking across the street here. I'm in a crosswalk, lights lit. It's telling me to go across the road. Some yo-yo's on his phone and strikes and hits me. More likely than not, when I sue him and his insurance company, mostly his insurance company, because his insurance company will pick up the tab on this one, compensation for my injury, in other words, my hospital stay, my loss of, well, not loss of work, but my hospital stay and other expenses that I incurred simply because of the injury will be excluded. Now, if I sue the guy and I say not only that, but I also want, $150,000 for emotional damage, that is fully taxable. or punitive. He was on his phone and should be punished for this. Okay, fine. We're going to do another $200,000 to Kevin because you're right. The guy shouldn't have been doing this on his phone. That $200,000 to me is going to be fully taxable income. But my hospital bills and all my other stuff that I had to incur because of this, wiped out. Healthcare reimbursement. Again, reimbursements by health and accident insurance for medical expenses are excluded. So if I go to the doctor, the other day I was going to the doctor and he said, "Gosh, Kevin, we're going to have to increase your blood pressure medicine." Imagine that. And I say, "Okay, fine." So we do that. When they reimburse me the money for the healthcare expense, I don't have to pick that up in income. I can't take that expense as a deduction though, because I got compensated for it. So I can't take that as a deduction. Again, the great balance sheet. All right. If the disability policy is paid for by the employer, they are considered non-taxable fringe benefits to the employee, and the employee must include disability benefits received in gross income. That is true. Deferral provision. Allow taxpayers to defer but not permanently exclude the recognition of certain types of realized income. For example, installment sales, like-kind exchanges, involuntary conversions. We've already talked a little bit about some of this stuff. The one that's actually kind of new this year for our discussions, we haven't talked about contributions to non-Roth qualified retirement accounts. There are some provisions that do exist. They're not going to be on the test. Don't worry about that. I probably won't. And if I do, I'll definitely let you know about it and we'll review it thoroughly. But again, kind of newish this year. So we're going to probably wait a year before we actually start incorporating that into the class. And all that. All right, guys. So that's the last video of Chapter 5. I want to say thank you very much for watching this video, and I look forward to seeing you guys in class.